What's up, guys? If you want to make money sports betting, this is the video for you. So we're going to be discussing positive EV bets, right? We talk a lot at Odds Jam about positive EV sports betting, how it's so powerful, so profitable. I've made hundreds of thousands of dollars positive EV betting, and the point of this video isn't to just talk about my wins, right? It's to explain to you why these concepts are so valuable. So first, let's go through the concepts, right? You need to understand how sportsbooks work, how markets work, how do sportsbooks set odds, right? Why are they pricing teams, giving you certain odds on bets? How do sportsbooks make money? Like, all these questions are critical to understand if you want to make money sports betting. So what we're going to do is we're actually going to start out with a kind of interesting example of imagining, you go to a bunch of card dealers and you're considering buying or selling this trading card, right? So here's just some Barry Bonds baseball card. And this is the way a market works, right? This is the way a dealer works, right? They make their money by charging a spread. So you go to a card dealer, let's say your first card dealer, the first card store next to you is called FanDuel, right? You may take this card to them and they may be like, hey, we'll buy this card for $180. And then a week later, you may go back and see, hey, they're selling it for $300. They bought it from me for $180. They ripped me off. Well, they didn't rip you off. They were doing their job as a dealer, right? Their job is to make that spread. They buy things for $180. They sell it for $300, and they make an $120 profit. That's how all card dealers work, right? They buy things what they believe is below market value, and then they sell things for what they believe is above market value or a premium to market value. So essentially, you could take this card to a bunch of different card dealers. Maybe DraftKings is the next baseball card store near you, and they may have a tighter market. They may say, hey, we'll buy this card from you for $250. Obviously, that's better than $180, and we'll sell it for $275. So here, the midpoint is $262.50. Right? We know this DraftKings card dealer, he thinks this Barry Bonds card is worth more than $250. Obviously, he's willing to buy it for $250, so he thinks it's worth more than $250 and less than $275. So you can assume the midpoint of where all these dealers, right, are willing to buy and sell is what they believe is the true value of this baseball card. So on MGM, maybe they'll buy it for $240, they'll sell it for $340. The midpoint is $290. So according to MGM's market, where they will buy and sell, the fair line is $290, right? And where people are putting their money, where people are buying and selling assets, doesn't matter if it's a bet, if it's a stock, if it's a baseball card, that is the most valuable information, right? Some people will be like, oh, this Barry Bonds card, I wouldn't buy it for $10. And it's like, if they were given the opportunity to buy it for $10, they'd obviously buy it for $10, given that they could go sell it at the BetUS, baseball card store for $258. So essentially, if you take an average of all these different midpoints of these different card dealers, the fair price or the average price of this baseball card of the midpoint would be $268. So that's called fair value. Based on all the data points in the market, what is the fair value of this baseball card, right? So you take the midpoint from all the dealers, then you average them together, it's $268. So long story short, if we could go to the Prize Picks, let's say on Prize Picks, they're like, hey, you want to buy this Barry Bonds baseball card for $220? It's like, obviously I do, because I know the average it's trading in the market is $268, right? So I'm getting a steal deal. I'm getting a discount. Now, it's the same thing in stocks, right? You have the bid-ask spread, as it's called. So you can do the same thing, right? You can imagine if there were dozens of stock exchanges all trying to price, Bitcoin or whatever, all trying to price some stock, Facebook stock, you can get a pretty good sense of where Facebook is trading in the market. And then let's switch over to sports betting, right? So for sports betting, it's no different, right? So you go to FanDuel and you can see the Thunder are plus 118, the Jazz are minus 138. So sportsbooks make everything a little more complicated because it's not in dollar terms, right? Like stock trading, baseball cards, it's in dollar terms, so it's easier to wrap your head around. But in sports betting, it's odds, right? And what you need to recognize is, in the same way buying and selling a baseball card is equal and opposite outcomes, same with sports betting. Betting on the Thunder is selling the Jazz, right? So you can either buy the Thunder money line at plus 118, or you can sell the Thunder money line at minus 138 and bet on the Jazz. These are equal and opposite outcomes, right? So buying the Thunder, same as selling the Jazz. Betting on the Jazz, same as selling the Thunder. So you can do the same thing here, right? FanDuel has a 20-cent spread. In the same way, a stockbroker will buy a stock for 15, then flip it for 16. That's a $1 spread. So the fair value, based on their market, they're willing to buy it for 15, so they think it's worth more than 15. They're willing to sell it for 16. They think it's worth less than 16. The midpoint is 15.50, so that would be fair value, right? That is the fair price of the stock according to FanDuel based on their market. So in sports betting, it's no different, right? So this is called the no-vig odds or fair odds, whatever you want to call it. But FanDuel has a 20-cent spread. The Thunder are plus 118. The Jazz are minus 138. So this is a bit of a simplification. But the midpoint would be 128, right? It's just a 20-cent spread. So the midpoint would be 128, which essentially means the Thunder, according to FanDuel's model, is fairly priced with no vig. Their true price, right, if you remove that spread, would be plus 128. That would be the fair price on the Thunder. The fair price on the Jazz would be minus 128. So what you can do is the same thing here, right? If a bunch of sportsbooks have odds, you take the midpoint of all of them, you take an average, and you get the fair price for both teams. So here, the fair price with no vig, according to the market, you have dozens of data points, right? So the fair price on the Thunder would be plus 130.17. So what that means is if you can bet on the Thunder at odds above plus 130.17, your bet would be profitable. Your bet would beat the vig, beat the juice, and your bet would be profitable. So this is kind of the same thing as taking the average, right, of all these different midpoints, which should make sense intuitively. If not, I encourage you to kind of think about these concepts, but it's the same in sports betting. So this is called your fair odds, right? You remove the vig. Sportsbooks make money the same way a stockbroker does. They buy things for 15, they sell it for 16. It's no different as a sportsbook, right? FanDuel is charging a 20-cent spread, buying for 118, selling for 138. That's exactly what they're doing right here. They're making that 20-cent spread. And it's a little less intuitive than, let's say, a stockbroker, but it still should make sense, even though it's not in dollars. Again, buying the Thunder is just the same as selling the Jazz, right? So you can buy the Jazz for $138, or you can sell them for $118 and bet on the Thunder, right? So it's kind of that same concept. So essentially, if we can get the Thunder at odds above plus 130, then we are getting a discount, right? We are getting value to what the fair market price is. So let's say if on some new sports book, Fox Bet, you can get the Thunder for plus 140, well, you're getting better odds than the true odds or the fair odds, so your bet would be profitable. Your bet would be positive EV, right? If the Thunder were plus 125 on Fox Bet, you'd want to skip it. You're getting below fair odds. Now, in the same way, if the Jazz were minus 140 on Fox Bet, you're getting worse odds than the fair odds. Minus 130, you're getting minus 140, that's worse odds. So you'd want to skip them. And if you're getting, minus 120 on the Jazz, that would be a no-brainer, right? Which should make sense. Just looking at other books, it should intuitively make sense. If every book in the market is pricing, the Thunder around minus 140, minus 145, whatever, and you can get them minus 120 on some new sports books, seems like a pretty good deal. So we can go back to the PowerPoint, but so sports books, they work the same way car dealers do, stock dealers do. They charge a spread. And what you need to remember is real-time market data right? The sportsbook odds, the odds they're putting out, it encompasses everything, right? If Curry's not playing tomorrow, that's reflected in the odds already, right? Like sportsbooks know everything. All public information is baked into the odds. If other bettors know it, then sportsbooks definitely know it, right? You also have to remember this market is based on supply and demand. In the same way, if a bunch of people are buying the stock, let's say on FanDuel, what FanDuel's going to do is say, hey, everyone's buying our stock at $16. We're going to start selling it for more, $16.50, and maybe we'll buy it for $15.50 now. Because everyone's trying to buy it from us, there's outsized demand, right? We don't want a ton of risk, so let's raise our prices. So then you're going to see the fair value goes up, right? It's a market based on supply and demand. It's no different in sports betting. If all the action is coming in on the Thunder, you'll see books go, oh, let's drop their odds to plus 108 and let's bring the Jazz to minus 128. Let's move odds in favor of the Thunder, right? Sportsbooks, they don't want a ton of risk. They're constantly trying to balance action coming in on both sides. They don't want risk. They want balanced money coming in on both sides so they can make their risk-free spread. In the same way, nothing is better for a stockbroker than having a bunch of people sell it to him for $15. He's buying it for $15 and then he's selling it for $16. All he's doing is making that $1 risk-free spread over and over. Buy for $15, sell for $16. Right? That's exactly what sportsbooks want, and they're constantly taking around odds to try to balance action coming in on both sides. So it's a market, supply and demand. Sportsbook odds are based on supply and demand. So again, real-time odds, it's just real-time prices. It encompasses everything available in the market, all public information. That's why odds are so much more valuable than historical stats. Historical stats are useless. You want to know what the price of Amazon stock should be? Go look at the price it's trading in the market. You have every smart hedge fund, pension fund, trading firm looking at the price of Amazon stock every day. If Amazon should be a higher price, it already would be a higher price. It would be trading at a higher price in the market. Right? This is just rational, data-driven sports betting. So a lot of people, will say, hey, in positive EV betting, you're not talking about sports. So, you think the people who make money on Wall Street trading are the ones who sit at home and read about stocks all day? No, it's all about the data, right? It's all about the data. So here we can see Crystal Palace, Aston Villa. This is a positive EV bet from OddsJam on BetMGM. You can get the under 2.5 total goals at minus 135 on MGM. You don't have to know anything about soccer. Right? Caesars pricing this at minus 150. DraftKings minus 175. Pinnacle, sharpest bookmaker out there, pricing this at minus 163. Betfair Exchange minus 146. Resorts World minus 170. Looking at every data point in the market, it should be very clear that, hey, this minus 135 is crazy value. You don't have to know anything about soccer. The sportsbooks already know way more than you. It doesn't matter how many soccer highlights you watch, these sportsbooks who invest hundreds of millions of dollars into their ability to set lines, they're smarter than you. They're smarter than me, right? Because sportsbook odds encompass, first of all public information. These sportsbooks are very good at setting lines. Caesars, MGM are billion-dollar companies. They're pretty good at setting odds, right? Your best chance of making money off them is picking them off when they're clear market discrepancies like they are right here. Right, so in general, sportsbooks are very good at pricing, but because they all try to set lines independently, positive EV betting is possible because you're just picking off sportsbooks when they're screwing up. In the same way, if we go back to this example, if there's, dozens of baseball card stores all saying, hey, the midpoint of their market is roughly, let's say, $268, and you can buy it on Prize Picks for $220, it's a no-brainer. You're buying it for $48 below where it's trading in the market. You don't have to know anything about baseball cards, right? You could literally buy this on Prize Picks and go sell it on BetUS and make a $38 profit, right? Buy it for $220, sell it for $258. So you don't have to know anything about baseball cards. This is just market-oriented, data-driven sports betting. And if, Like, why? You don't have to know anything about soccer. There's dozens of sports books. Well, not in my location, but if we switch to another one, I have a bunch of sports books filtered out. But you can see for a lot of these plays, like this college basketball play, it's like you have dozens of sports books, dozens of data points all telling you what the price should be, where the line should be set. It's like having dozens of prices of a stock, right? On every stock exchange, a stock is trading at $140. You can buy it for $120 on some, new exchange. That's a great deal. It's trading in the rest of the market at 140, and the market is smarter than us, right? The sports books are smarter than you. So, again, if you don't believe in positive EV betting and following the odds and looking for value, you not only think you're smarter than the books, who have hundreds of traders, right? They invest millions of dollars into their ability to set lines, but you also think you're smarter than every other bettor because sportsbooks set their odds based on supply and demand. So, for example, if you just assumed the Eagles were going to win the Super Bowl and you just bet on them blindly, sure, it may be a fun bet, but if you were expecting to make money, or if you're expecting to make money long-term betting on sports, there's tens of millions of people, if not hundreds of millions, betting on the Super Bowl. Those markets are very efficient. So unless you're smarter than every single bettor, you're literally just paying the spread, the VIG. You're literally just paying the spread. So positive EV betting, again, it's not hard. On OddsJam, you're literally just looking for this bet in green. That's the play with value. So here, Flames -2, you're getting it frickin' plus 214. No other books better than plus 186. Clear value, enough to beat the VIG, beat the spread, and for the play to have an edge. So that's positive EV betting. Any questions you have, don't hesitate to reach out. Let's make money.